Hello and welcome back to Channel 11. I'm your host, Ken Shinoda. Today is Tuesday, June 9th, my birthday actually, and we're going to review May and a few business days into June. Title of this Channel 11 is Stock Soar, Bond Snore, because stocks have been ripping outside of last Friday. Saw a big sell-off with that jobs report, and bonds have kind of done nothing this year. So here we see the land of gains. Equities made a new high. And that sell-off we saw on Friday, things have stabilized, starting to recover, especially with tech. We look year to date, and May plus these few business days of June, sorted by May returns, and you can see momentum in tech kind of on fire. Utilities, a laggard, down about 5%, and so really it's kind of that rebound in tech driving things, rebound in growth driving things. Also healthcare, that has lagged year to date, catching a bit too. But the big winners year to date, still energy. Energy off a little bit with the drop in oil, and momentum and tech really leading the charge. Globally, EM, the laggard, through May, only up 1.8%, still up almost 18% on the year. The big winners this year, Nikkei, Dow Transports, and Russell 2000 up 15%. Europe lagging with high energy prices hurting their more manufacturing economies, and natural gas prices high as well, affecting Europe too. Mag 7, here we can see that pullback. A lot of that just happened last Friday, but up big on the year, especially off the April lows. And that's also reflected with Mag 7 being such a big part of the S&P 500 that it's lagging the equal weighted into that recent sell-off that we saw. Crypto, kind of a correction we're seeing in crypto. Bitcoin, Ethereum down big, Solana, Dogecoin stabilizing a little bit here, but I think you're seeing some rotation out of crypto into the AI trades. Gold consolidating, silver consolidating. Also, if the Fed's going to hike rates again, maybe that would see some more gold weakness. But for those that still like this concept as part of their portfolio, this is maybe giving you another buying opportunity. But I could see gold drop down back to that 4,000 area. Semiconductors ripping. It's a yin and yang story with the chips that are going into the data centers doing really well. And then the companies that are going to be displaced by AI underperforming, but had a little bounce very recently. Here you can see that bounce. These are some of those big software names: Salesforce, ServiceNow, Adobe, Intuit. Little bounce off the lows, but probably continued weakness here. I think there's been continued rotation out of these sectors into other sectors, especially sectors that will benefit from continued capex from the hyperscalers. International equities doing well. Nikkei, one of the top performers. EM, one of the top performers this year. In Europe, lagging for all the reasons we talked about. There's not as much tech in Europe, and they're heavy manufacturing economies, and they're underperforming. Make Europe great again. Here you can see the underperformance of Europe versus the S&P 500. And I think with that weakness, you're seeing kind of the weakness in equities. You're seeing that reflected in the currency markets as well. Dollar getting a little bit of a rebound with the Fed on hold, even pricing in some hikes now in the bond market. So I think the dollar probably hit some resistance in this 101 area. We're right at 100 right now, but caught a bit off the lows in that 97 area. So I think we're going to see a new trading range on the dollar, kind of the par and a half to 101 as the ceiling, and you've got this kind of 97 area as the floor. Yen coming back up to the ceiling level we've seen a couple times at 160. Seems to be a decent buying opportunity when we get up there. Especially if they start hiking rates. There's some talk of that now, and that could help support the yen. Commodities pulling back with energy after this huge run. I mean, finally took out that top in 2022, and we've seen this big bottoming process into 2024. Then this big run up. A lot of it has been energy. Here you can see year to date, energy, crude oil, Brent crude up almost 85%. But they have been selling off this month. So in May, it's really the sell-off in energy as there's hopes of a conclusion of the conflict or some kind of opening of the Strait of Hormuz. Now, economically, services remain strong. And I think that the big story is really manufacturing is coming back with all this capex from the hyperscalers and data center infrastructure build out. You're seeing a big boom in manufacturing, and that was one of the sectors that had been in a recession through much of the rate rise starting in 2022. People pointing to it saying, hey, we're going into a recession, look at manufacturingism. But the economy is largely services in the US, but I think this is good news for the manufacturing sector, and that's why you're seeing some strength in some of those industrial names in the equity market. Global manufacturing, north of 50 outside of, looks like Euro area, and exactly what we talked about. That's where the weakness is. And services also expanding everywhere outside of Germany and looks like UK. Atlanta GDP now, still looking like we're not in a recession and the economy is doing okay here. Moving on to the bond market, treasury yields rising across the board with conflict going on, and the market went from pricing 3 Fed cuts to now the market's basically telling the Fed maybe you need to hike, with the 2-year now above Fed funds. So I think you've basically moved away from 425 on the 10-year kind of being the center of gravity to now 450 on the 10-year is the new center of gravity. So I think we're going to trade range bound around that 450 level on the 10-year. The long bond held that 5% area, which is good news for now. I think, as I said on the last Channel 11, if the 30-year breaks above 5%, you'll see some weakness in equities. That happened. You saw some weakness in equities. But now with the long bond holding around that 5% area, I think that gives some stability to risk markets. And I think it's been a pretty orderly move. I don't have a chart of it, but if you looked at the MOVE index, which is the vol of rates, it was pretty low relative to the spike in move that we saw during the 2022-2023 rate rise. So there wasn't a lot of demand for protection from the bond market. So I think this move was pretty orderly with the conflict going on in the Middle East, energy prices up. It makes sense the Fed shouldn't cut, maybe even they should hike. And so we've seen the whole curve kind of repriced to a higher for longer type environment. But for now, I think the market is not terribly concerned about core inflation, because a lot of the components of core have stabilized. You don't have housing prices going up; they're kind of going sideways, even down in some cities, and the job market's more balanced, so wages aren't rising as quickly. And so really it's all about an energy story. I think the risk is that if the conflict continues, oil prices stay higher for longer, and then you also have pressures from all this data center capex from the hyperscalers that could push some parts of core goods up, because they probably are price insensitive to how much you're paying for chips and HVACs and construction materials and things like that. Curve has been bear flattening, with the 2-year coming up and the long end kind of staying where it is. And here you can see break evens. You saw that spike in 2-year break evens, but that's coming down now with energy prices coming now. So this is good news for the market. We talked about last time, if you get the 5 and 10-year break even inflation rates, market's expectations of inflation starting to rise, that's bad news. And so seeing these come down, I think, is good news for risk assets. Moving back to the bond market, May, slightly positive month across the board outside of CCC high yield, with rates stabilizing, earning your coupon. Year to date, it's the floating rate stuff that's winning, shorter duration stuff that's winning, levered loan CCCs, the laggard there. But even bank loans broadly that were lagging, the market recovered. Now doing better than the broader bond market. Bond market up only, not even up, down 20 basis points now year to date through June 8th. Spreads tighter across the board outside of bank loans because of software. This shows legacy RMBS wider by 20. I actually don't think that's right, but I don't know where they get the data. CLO triple Bs wider a little bit because of the underlying bank loans they own, but outside of that, spreads have been coming in across the board. So really it's a rate story. Credit markets are doing okay from a spread standpoint. It's just that rates have backed up, and that's why floaters have done well. Here you see a little bit of widening in the IG and high yield markets into the start of the conflict in the Middle East, but now we've grinded back down to 265 on high yield, near the lows, same with IG. So credit's doing well. Really it's a rate story. And here's what looks cheap out there. Still the securitized sectors look a little bit on the cheaper end. Sorry if I don't have my usual energy. I just got back from a family vacation, coming down with a little cold or something. So thanks for sticking with us. Hope you enjoyed this Channel 11. Good luck out there, and we'll see you next time.